very much, Linda, and thanks to all of you who are joining today. All right, we're going to jump right in because I know it's an interesting time to be in banking when you think about overdraft services and a lot of questions that we get asked about what's going to happen. So there are three forces really affecting overdraft here in the early part of 2022. The first is potential legislative changes, concern about will Congress act. The second is potential regulatory changes. Will the CFPB act to write regulations? And finally, industry and competitive changes. This is really, I'm going to give you the punchline now, which is this is really the most important one. This is the one that's really driving the most change in overdraft today. But we'll talk about each one of these in order. So on the legislative side, I think this headline from last summer is still accurate, which is that the bills that are around things like overdraft really are doomed in Congress. There's a service called GovTrack, and they give this legislation a 3% chance of advancing, which is pretty much a 0% chance. We've seen Congress be unable to actually get legislation through that it seems like a majority of the Congress agrees on, much less trying to get legislation through where there's a lot of controversy. The legislation you see, actually the one in the House, has been introduced now for about 10 years by Carolyn Maloney, Congresswoman from New York. That legislation has never actually even made it out of committee. So that's where I think it's going to die again this year. So won't spend a whole lot of time talking about that, except to say that I think one of the big reasons that it hasn't advanced is that people in Congress realize there would be a lot of unintended consequences if we stripped financial institutions of this really important source of fee income. So the first thing to think about is if all of your overdraft income went away, what would you do? Would you still be able to offer your members, most of our credit union clients are able to offer their members either free or can make it free pretty easily, checking accounts? Would you still be able to do that if all of your overdraft income went away? And the reality is that people who are lower income really are the beneficiaries of that, where those who pay overdraft fees essentially are financing the cost of banking services for those who are at the lower income stratum. And we can run programs responsibly so that those people who are lower income are not, in fact, the ones paying the overdraft fees. And we'll talk about that later in the presentation. But if you saw overdraft fees substantially reduced, I don't think it would be surprising to see you charge not $14.95, $19.95, or whatever it is per month just to have a checking account, which would really drive a number of those consumers out of the banking system. And we do believe from talking to people in DC that this is one of the reasons that the CFPB under Richard Cordray didn't really move forward with overdraft rulemaking. And this is not just our opinion or our guess. In fact, there was a study that was released by the Federal Reserve Bank of New York last summer. And what it actually showed was that in areas where there are overdraft fee caps, and they were able to study areas where there were and were not these fee caps, but what they found is where there were fee caps, ultimately consumer protection by restrictions on overdraft comes at the cost of reducing banking services for low-income households. And I don't think there really are any legislators or regulators who have a goal of reducing banking services for low-income households. Second, they went on to say that while the fee caps do limit the fees as intended, they also constrain the supply of overdraft credit and reduce financial inclusion among lower income households. Again, something I don't think that anyone who is a policymaker wants to do is to constrain the supply of credit or liquidity to consumers or reduce financial inclusion among those lower income households. So not just that about potentially pushing consumers out of the regulated banking system, but some other reasons why I think legislation doesn't really have a chance of moving forward, regardless of whether that's this session or if there is a more activist Congress in the future. The second is that there was a study done by the American Bankers Association where we were able to help them out with some information. And there's a link to that study. It's a pretty interesting one. So the ABA commissioned a consultant to do this. And what they found is in the responsibly run overdraft programs, consumers ultimately derive a significant benefit from the overdraft. So typically of more than 7-to-1, the benefit they receive versus the cost they paid. There has subsequently been another study done by Trueist, which is the new name for Novantas, which is a consulting firm. They found that the average amount really covered by overdraft went up from around $50 a few years ago to $200 today. So really that justifies that high return on the dollars consumers spend Where else can you get that sort of lift on the value of what you spend in liquidity? And it's not just liquidity that goes to consumers, it's also liquidity that goes to a lot of the communities where you as credit unions serve the people in those communities, a lot of which banks like Bank of America have pulled out of. And that's major economic stimulus. Just in the data the ABA looked at, was an economic stimulus of over $65 billion a year that went into Main Street America businesses, like small businesses that are able to pay their employees because the customers have their transactions paid instead of returned. Also, this false narrative we see in the press that low-income consumers pay a lot more in overdraft fees than higher income consumers is just not true in responsibly run overdraft programs. In responsibly run overdraft programs where we're focused on the ability to repay, in fact, the data from the ABA showed that higher income consumers paid 80% more in overdraft fees than low income consumers. They looked at consumers who had deposits of less than $24,000 compared to consumers who had deposits of more than $60,000. And the group that had more than $60,000 in deposits was paying 80% more fees. So the narrative in the press just is not true when you really dig into the data and you run a program responsibly. Another really big point about why we think the CFPB is not going to make overdraft rules is that the complaint data they will tell you on their website is what drives their rulemaking. And that's been the way the CFPB has worked almost since its inception, is that complaint data drives our rulemaking. The complaint data to the CFPB on overdraft is less than 0.15% of the complaints. And that was during 2000, in the middle of a raging global pandemic. Less than 0.15% of the things consumers complained about were related to overdraft. And that number has stayed roughly the same for the following year or two. So just why would you solve a problem that doesn't exist in consumers' minds? Next, as you know, back in 2010, we had to go through an exercise to opt in everyone who wanted overdraft transactions paid on their everyday debit card and ATM transactions, in which those consumers agreed to pay a fee. Millions of consumers have said back in 2010 and since then when they opened their accounts, yes, I understand there's going to be a fee on this overdraft transaction, but it's important to me and I want my items paid, so I've decided to opt in. Why would we take away that consumer choice? And if we, really importantly, if we deny consumers this source of liquidity, they're going to go somewhere else. Just because overdraft diminishes doesn't mean that the liquidity need diminishes. No matter what, consumers have real needs for short-term small dollar liquidity. And what we don't want to see them do is go into the arms of payday lenders, pawn shops, online alternative lenders who charge very high rates of interest. If you're curious about how easy it is to get one of these loans, I would encourage you to look at lendup.com, lendup.com. Lendup is an online payday lender. APR is typically over 400%. Loans typically of 2 weeks or less, where there's a constant cycle of debt. That's what's going on out there. A lot of the storefront lenders also offer online products as well. And those tend to be accessible to people, even in states where their state's usury law would actually legally prohibit those loans. But of course, a lot of those providers really run under the radar, and there's limited enforcement against them. And finally, there are some excessive burdens in this legislation I won't talk about, but that make it really impractical to advance. On the CFPB side, the overdraft rulemaking that was put on the agenda quite a while back was taken off under Mick Mulvaney's time as the acting director of the CFPB. The Bureau actually started looking at overdraft. It's been 10 years ago this month, February of 2012, but ultimately didn't move forward with any rulemaking at all. The latest salvo we saw from the CFPB on overdraft was soon after Director Rohit Chopra was confirmed as the director of the CFPB, went after overdraft fees on December the 1st. That's an important date. I'm going to reference that date in a moment here, but pointed out what he said is the heavy reliance on overdraft and NSF fees, and cited, and the bottom portion there, cited a couple of enforcement actions that were taken against banks. One against TD Bank, which was actually under Kathy Kraninger, the Trump appointee to lead the Bureau, and the other was a case against TCF, which is several years old, but underscores the way the CFPB under Cordray operated, and we expect the same way it will under Chopra, is largely regulation by enforcement. Good news for you is if you're a credit union that's under $10 billion in assets, the CFPB has no authority to supervise you or to bring enforcement actions against you. But it's an indicative of how they are thinking. Those two actions they cited were directly related to Reg opt-in practices, which is something we encourage all banks and credit unions to be very careful about how you do that to ensure the opt-in actually reflects the consumer's choice and not a bias on the part of the banker who is making that decision or entering into your system. So importantly, in these announcements, there's no mention of future regulation. There was one mention of potential guidance, which would not have the force of regulation. And in fact, there's an open question about whether the CFPB even has the authority to make rules on overdraft. When they did last have overdraft rulemaking on the agenda, as you can see in the highlighted portion at the bottom, their legal authority to do so had not yet been determined. Generally, there's got to be a federal law that would allow the Bureau to make these rules. In the case of the changes to Reg E that we saw that required opt-in on debit card, everyday debit card and ATM transactions, the Electronic Fund Transfer Act gave authority to make those rules to the regulatory agencies. There is no federal law that would give them the authority to tell you what you can and can't charge for overdraft fees or how your fee structures should work. But if you think that they would potentially make regulation anyway, which, who knows, the things that were on the agenda last time were 5 main things: the opt-ins, which we've talked about. The second is overdraft coverage limits, and I'm going to talk to you about that particular topic here a little bit later in the presentation. Posting order practices, you may be familiar that this is something that the litigators have really been busy bringing class action lawsuits against credit unions. And unfortunately for you, the credit unions were the first ones that got hit with these before the banks. I'm not sure why, but this legislation's been going on for quite a while over posting order, particularly authorized positive, settle negative transactions. The next one was fee structures, and actually Richard Cordray is on the record saying, I don't think we can tell you what you can charge for an overdraft fee. I don't think that's something that under our statute that Congress would have expected. But I do think what that means is the continued push from all regulators to have some sort of daily cap on the number of fees you charge and some sort of de minimis amount, an amount below which you won't charge any fees if the account's overdrawn by less than, say, $10 at the end of the day, or if an individual transaction is for less than $5, for example. And finally, involuntary account closures or charge-offs is a concern that directly ties the number to the overdraft coverage limits being inappropriate. We don't want people to charge off. And importantly here too, none of these things signal any kind of end to overdraft. Thus the theme of the presentation that overdraft isn't over. We did see the OCC controllers give a speech also in December, where I think it's critical that he did recognize that limiting overdrafts may actually limit the financial capacity of those who need it most, but emphasizing the importance of using financial health as a yardstick by which to assess the products that we offer to consumers in our credit unions. And in fact, looking at the ability of individuals and families to meet their day-to-day obligations and needs, absorb and recover from financial shocks. And an overdraft is a financial shock. So how do we make sure that people are able to recover from that financial shock? Well, the answer is making sure they have the ability to pay it back. So that's the legislative and regulatory part. The competitive part is where I want to spend some time talking about what we've seen in the market. And Ally Bank was really the first bank that came out and said, we're going to eliminate overdraft fees forever. And I would tell you that move really wasn't all that generous of a move on their part. This is a column our friend Ron Shevlin at Cornerstone Advisors writes on Forbes.com, where he pointed out that overdraft fees at Ally Bank accounted for just a James Bond-ish 0.07% of Ally's revenue the prior year. So was it really something big for them to give up? No, but it did get them big headlines. And so I also, wanted to point out again here, December 1 being the state, when Capital One said it's going to give up its overdraft program, it's going to give up its overdraft fees and give up a substantial portion of its revenue. I don't think it's a coincidence that the same exact day that the new director of the CFPB came out blasting overdraft was the exact same day that Capital One also decided to make its announcement about its end to overdraft fees. So I don't know, I don't know what the direct connection was or causal connection was there. I just pointed out is that if you're cynical, it seems like there is some sort of potential link there. In any event, the last bullet on this page is the one that's really important for what we want to talk about how we go forward, is that the customers who pay the fees, who are in the overdraft program, will be automatically rolled over into a free overdraft protection service. It does not say that they get to stay in the same overdraft protection service. They're going to be rolled into a free overdraft protection service. So that really leads up to the answer to the question I get asked most often about what's going to happen here. Well, I think there are three things that are going to happen. The first one is that these big banks, the Capital Ones, the Wells Fargo's, the Banks of America, they are going to make up these fees somewhere. Remember that unlike credit unions, they are private entities, often publicly traded, where management teams are incented based on the stock price through the form of options, restricted stock, and other forms of compensation. So they're going to do what they need to do to get the earnings up and to get the stock price back up. In other words, they will make up these lost fees somewhere. So the easiest place to make those up would be in monthly fees. And we've already seen the damage that increases in monthly fees can do to low-income consumers, but I'm not entirely sure that that's going to matter here. So I do think that you're going to see, and I do not think it's going to be immediately because it just doesn't look good for these big banks. But I do think that within the next couple of years, banks are going to do either one or two things or some combination of them. They're going to implement fees where they didn't have fees before, or where most of the large banks do have a monthly fee of some kind now, they make it relatively easy to waive it. They can have monthly direct deposits of as little as $250 is one of the large banks. Some might be $500. And you can imagine in a rising interest rate environment and assuming that credit quality is good and you can make a lot of loans, you can imagine how important those low cost deposits become when a lot of banks have actually not actively sought deposits because of the environment now. But when you've got 0% interest you're paying on deposits and you're able to lend that out at higher rates, those deposits become important. And so to waive the fees, instead of $250 a month in deposits, you might start requiring $1,000 in monthly deposits. You might also, where you've got a situation where your fee waiver is based on a balance, minimum balance, for example, instead of $1,000 minimum balance to get the fee waived, you might have a $5,000 minimum balance. That makes it harder for low-income people to get the fees waived. The second thing that I think is going to happen is that overdraft liquidity is ultimately going to get in some way cut or reduced. So let's think for a moment about a situation where Capital One, for example, typically in our programs that our clients run, they're going to give a maximum overdraft limit of up to $1,500. And what they'll do is the Capital Ones will do note where they're going to put you into a different overdraft service. They're going to probably not offer you up to $1,500 in liquidity anymore. If you think about that and you're running this program at Capital One and you just took away the ability to charge fees, are you really going to take the risk of paying up to $1,500 for an individual consumer? Probably not. Other options would be just decreasing the number of items paid. If you used to pay whatever there were, now you maybe only pay one or two, or you just cut off access to overdraft liquidity entirely. And then third, what I think is going to happen is that all credit unions and all banks are going to need a short-term small dollar lending alternative to overdraft if you want to continue to have overdraft as well. And regardless really whether you want to have overdraft or not, it's a huge need. So what this does is it sets up a competitive landscape where the financial institutions that are able to offer these limits are going to win. So if your credit union gets asked the question, hey, wait a minute, how is it that you guys are still charging a $30 overdraft fee, for example, and Capital One isn't charging anything? The answer to that question is, well, the difference with us is we'll actually pay that. We'll actually cover that item for you. Call up Capital One and ask them whether they're going to pay up to, say, $700, $800 or whatever the limit is for that individual consumer. First of all, they're probably not going to answer the question. And second of all, they're probably not going to have a limit anymore that actually will cover people who want to use overdraft. So this is not just theoretical on my part. Trueist actually made an announcement where all of these things, all of my predictions came true. The first is they announced that in their new their new overdraft fee accounts, the limit would be $100, which is really irrelevant for people that use overdraft. They also went down the road, as I mentioned, they're going to offer a small dollar loan, in their case, a line of credit for which they haven't announced the fees. And finally, these accounts, the new accounts and no overdraft fee accounts, may include a monthly fee. So all of those things coming true in one place. So also, it just isn't a good idea to reduce your fees. You'll get the slide, so I won't read all of this to you. But really, I think it's important to note that the survey data shows that consumers don't seem to really care. It's something that, as this article says, out of sight, out of mind for many of them. And despite what PNC and Ally, I mentioned specifically, have done, it hasn't made them look any more favorable in the eyes of consumers. So I was interviewed by the financial brand, and a couple of answers here to this is, I do think that overdraft short-term liquidity, overdraft is still going to be part of short-term liquidity. Nothing changes the need. Consumers still have that liquidity, but I do believe financial institutions can be more responsible in ensuring that only those who have the ability to repay are able to use the service. So just a few quick questions. Do you probably, if you don't, you most likely have a fixed overdraft limit, but how many of the people that you've got a limit outstanding for haven't made a deposit in the last month? How many of yours people that are making higher incomes are you declining when they bump up against that limit? How many do you charge off because they couldn't repay the $500 limit you gave them? And importantly, how many of them are paying a disproportionate percentage of their deposits and overdraft fees to you? So, simple example about why we think ability to repay is so important. Imagine we have three consumers. One makes $1,200 a month, one makes $3,500 a month, one makes $10,000 a month, and we give them all the same overdraft limit. So for the one on the left, that's almost half of that person's cash flow. For the one on the right, it's only about 5% of her cash flow. Are we really serving these people best? I would argue that we're really not probably serving the ones on either side the best that we can. And so, what we're advocates of doing is what we call managed limits, where instead of giving a limit for an account type, in this case, most of the accounts had a $500 limit. You've really got risk over here where you've let people who aren't making deposits and just opened a certain kind of account, so we gave them a certain limit. And in the same token, I'm not sure you're providing great service to those people who have limits that are too low. So what we advocate for is something that looks more like this, like the goalpost from the Super Bowl, where you've got more people on the left-hand side who you're going to take down to a zero limit because the risk there isn't enough to justify leaving a limit out to them. But you want to provide better service on the right-hand side, which has some revenue benefit to you, but that revenue is driven by higher income people who can afford to pay those fees. And we really are able to provide a rainy day sort of protection and decrease these limits over time, or increase them over time based on what's happening in the account. And short-term liquidity, I do think, as I mentioned, I do think that becomes really critical, is offering alternatives to people instead of overdraft. And also to be regulatorily defensible. I think when you get told by an examiner, gosh, you guys make a fair amount of money on overdraft, I think that one of the best answers is yes, but we offer a less expensive alternative in the form of a small dollar loan, because we know there are two kinds of consumers. There are those who really want to be able to swipe their debit card and have it always work, and there are some who don't. There are some that want to plan. So I think the answer in terms of how we pivot going forward, as well as some more innovative fee structures, which we can talk to you about in more detail offline, but updating your program so that it really is responsive to ability to repay and really is focused on basic fairness, on things like looking at what percentage of people's deposits do they pay in overdraft fees and automatically adjusting their limit based on that. For the example, someone that makes $1,000 a month in deposits should not be paying you $200 a month in overdraft fees. Do you have the ability now to make that adjustment automatically? And on the other side, those consumers who don't like overdraft, once you didn't opt in under Regi, they don't even know that overdraft works. They don't even know that their debit card will work if they swipe it and you have a limit available, because they didn't opt in. So you're not going to cover them. And there's also a whole group of people that just want to be planners. They know they have an expense coming up, and what they want is a loan that they can pay back over 3 months instead of, as the overdraft rules go, they have to pay off their overdrawn balance immediately, and you're going to take it out of their next deposit. They want to be able to catch their breath and have a loan, for example, for a 3-month period. The large banks are doing this. Just in the interest of time, won't read this, but ultimately, the regulators are encouraging banks and credit unions to do this. The NCUA has joined the statement saying We also want you to use alternative data. In other words, in the bottom paragraph here, including cash flow data derived from consumers' bank account records instead of FICO scores, where you're able to actually offer more people liquidity than you would with a FICO score. So our take is what to offer members is 24/7 access to credit. If I'm in the line at Walmart and I came in to get $20 worth of stuff and I have $150 worth of stuff in my cart and I only have $80 in my checking account, how great would it be to be standing in the checkout line and get a loan for $200 that I can repay a third each over the next 3 months? You're able to offer far more reasonable interest rates. For federal credit unions, there is regulatory certainty around these programs also around what the rates can and should be through the PALS, the Payday Alternative Loan Program. There's actually a first version and a second version of that. We know you need to be able to automate it so that it doesn't require loan officers and drastically reduces the cost and improves efficiency for you. And finally, we want to have underwriting that results in low and controlled charge-off rates, typically less than 3% or less than what the credit card, similar to or less than what the credit card charge-off rate would be. So that's what I've got, and would love to open it up for questions if there are any.
Christopher, thank you so much. That was a really great and informational session for the credit union leaders joining us today on overdraft strategy. We'll give it a second here. If you have any questions, please feel free to enter those, as Christopher said. And thank you again, Christopher. That was just
Sure.
a lot of and wonderful information.
Thanks. And would be, if you, my email address is right there, Christopher@myvelocity.com. That's my direct phone number. Would love to hear from folks if there's anything we can do. I know this is something that a lot of credit union leaders are thinking about is how do we need to reposition given this pressure on overdraft in the market? How do we do that? How do we make sure we're still best serving members and also mindful of our bottom line? So would be more than happy to talk with anybody about bounce some ideas off of you and me, how we do that the best we can.
Fantastic.